Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at Nike's earnings for quarter 3 of 2020. So let's get started. Before we begin, make sure to hit that subscribe button, and I'm also streaming on Twitch and Mixer on Monday and Wednesdays at 8 o'clock Eastern Time. You should see the information below, so go ahead and see you guys tomorrow. I'm probably going to talk about Micron's Technologies earnings tomorrow, so let's get started. All the information that we're about to see, I've either collected from seekingalpha.com or Nike's investors website. So let's take a look at after hours and how the company is doing. So remember, it reported earnings today after hours, and today was one of the I think it was the biggest percentage increase in Dow history since 1933, if I remember correctly. The stock itself is up 15% just on the day, and after hours right now is up 10%, sitting at $79. And right now, just to keep an example, this company is it was at all-time highs of $103, so $80. So that means it still has about another 30 plus percent to reach its all-time highs. So that's where the stock is sitting at. So in today's episode, what we're going to look at is we're going to look at how they did on earnings. We're going to take a look at the balance sheet. We're going to take a look at the income statement. We're also going to take a look at any news they have about the coronavirus and how it's impacting this company. And I'm going to use that information to help me see how to kind of evaluate my future companies that I'm going to be looking at. And at the end, I'm going to give my valuation and my own opinion of what I would do with the company. So now we're here on seekingalpha.com, and we can see for quarter 3 non-GAAP earnings per share, Nike reported 78 cents, which was a beat by 22 cents. GAAP earnings per share were 53 cents, which were in line. And it had a revenue of $10.1 billion, which was a beat by $530 million. That's about a 5% beat. That's actually a pretty nice beat. Year-to-year revenue is up 5.1%. And like I mentioned, the stock is up pretty heavy. All right, guys, so first, let's take a look at what they presented to us in the Investors Relations website. So this is for the third quarter of 2020. This quarter ended in February 29th of 2020. So just for some timeline sake, at this moment of February 29th, 2020, United States and Italy and all of Europe were still pretty much open. The only place that was really affected right now by the coronavirus was Greater China and maybe the areas around there like Tokyo and South Korea. But before then, at this time, Italy and United States and all of Europe was still open. So that's good to know, just to see how much affection has happened just from there, and can kind of give us an idea of what to expect from future companies. So let's take a look at the highlights, and then we're going to break up into different segments. So highlights: revenue rose 5% compared to the same time last year. We already saw that digital sales, which I thought was pretty important. Digital sales are up 36% year to year, and like I said, I already took a read of this, so I know a huge portion of that has to do with Greater China revenue was a huge portion of digital sales this year, this quarter, just because a lot of the stores were closed down. Diluted earnings per share were 53 cents. There was a non-cash charge of 25 cents, which was some strategic planning with them for a distributor model in South America. The final highlight that they mentioned is inventory increased 7% to 5.8 billion, but closeout inventories units declined versus prior year. So that means that the inventory that was there from prior year did start to decline, which is a good thing. All right, so now we're going to talk about revenue. Revenue, like I mentioned, increased to $10.1 billion in this quarter, up 5% compared to the same time last year. Here they mentioned that Nike Direct, right, because this company has two major products we're going to see. It has Nike Direct and it has Converse, pretty much distributed. These are the two major lines from Nike. So Nike Direct grew with digital growth of 36% and strong growth across Europe, Middle East, and Africa, the Asia Pacific, and North America. And they offset the impact of coronavirus and their business to China. But digital sales in China did increase more than 30%, while brick and mortar retail were impacted because of the closures of the stores. So like I mentioned, right, revenue, Nike has two forms of revenue. It has the first from Nike brand and it has the second from Converse. Out of that $10.1 billion that we saw, $9.6 billion is made out of the Nike brand. So that's about 96 or close to 96% of the total revenue comes from the Nike brand, which is up 6% compared to the same time last year. They had double-digit growth in Nike Direct and growth in households. Their key categories included sportswear and the Jordan brand, and continued growth across footwear and apparel. So it does seem like we do see some growth in all of their sectors. We're going to see a quick breakdown in a bit how each of those are actually doing. But revenue from Converse as well was up to $506 million. So only 5% of the total revenue is made up of Converse, but it's up 11% compared to the same time last year. And it's mainly driven by double-digit growth in Europe and in digitally globally. Talking about the income statement, right, we still have gross margins decreased only 80 basis points. To decrease 80 basis points, I think it's actually pretty impressive, even though for most of this part, right, Greater China, I think China closed down in probably late January. So it had about a month of China not really being an active part member. So it's still pretty impressive that they only dropped about 80 basis points. And the main reason is because China is one of their highest margins country-wise. So they sell for what they make in China. They sell it for, they collect more margins there because most of their products, right, are made in China. So they don't have to worry about shipping and all that. So we can see why they have the higher margins there. They also mentioned that gross margin also declined due to the changes in foreign exchange rates and the incremental tariffs in North America. So the tariffs, the trade war is affecting Nike in one way or another. And the second thing, the stronger dollar makes it harder for people to buy products in America, right? So it definitely impacts the gross margins in that matter. One thing though, we are going to see net income decrease 23% to $847 million. So net income last year was over $1 billion. So diluted earnings per share decreased by similar percent. But we know that, right, if we take a look at diluted earnings per share, about 27 cents 25 cents are related to a charge that they had. Even though charges like this I think should be included, it's just good to know if that charge wasn't there, I'm pretty sure this net income would not have seen a net decrease. All right, so now here we're taking a look at revenue based on geographic region. So in North America, revenue grew about 4% compared to the same time last year, and we saw a 5% increase in footwear and a 5% increase in apparel. In Europe and Middle East and Africa, we saw an increase of 11%. And let's just take a look at portion. The biggest first, before we continue, let's take a look at how much North America and everything else works. So North America is about 40% of the total revenue. Europe seems to be about 27%. China is about 15%. And Asia Pacific and Latin America is about 14%. So that gives you close to about 100% of the total revenue, give or take. I did a quick math there, but it's just to see where it impacts. And China, right? China seems to be only 15%. So for China to be down for just a little bit of time, and this upcoming quarters, we're going to see China down, we're going to see Europe and Middle East and Africa down, and we're going to see North America down in sales. It's just something to keep a note of what's going to happen for next quarter. But North America, like I said, up 4% year to year. We see 5% increase in footwear, 5% increase in apparel. Next, we have Europe, Middle East, and Africa, which is up 11%. There's some strong growth going in Europe and that part of the world. We see 8% growth in footwear, 19% growth in apparel, and 14% growth in equipment. In China took a big hit, right? And that's crazy. China took this hit, and it was this, like I said, this only counted for about a month of China being down. So a month of China being down caused footwears to go down 4%, caused apparel to go down 10%. Equipment, for some reason, actually went up 7%, but totally China lost 5% revenue compared to the same time last year. Asia Pacific and Latin America is up 8%. We see 6% growth in footwear, 14% growth in apparel, and 9% growth in equipment. So we can see outside of the United States makes up for about close to 40% of total revenue. So that's something to definitely keep in mind of for what happens in the upcoming quarters. All right, so that's pretty much with the company's income statement. Next, let's take a look at some share repurchase that this company has done. During the third quarter, this company bought 9.6 million shares at roughly $957 million. So what does that? It's that close to about $100 a share. Right, let me just do a quick math real quick. So 957 divided by 9.6. They paid about $100 a share. So if they would have waited a little bit, they would have bought more. They could have bought more. They could have bought cheaper. But this company has a $15 billion buyback program. At the moment, this program has only used $3.9 billion. So this company still has about $11 billion to use for buyback program. And in this conference, they did not mention that they're going to cancel buyback programs. So that's a plus for now. But we have to see how Europe and North America being down will affect this. All right, so next, let's take a look at this company's balance sheet. First, the main thing they're talking about is inventory. Inventory was up 7%, up to $5.8 billion. And this is pretty much showing that they anticipate a strong demand once everything turns back on. They're anticipating a strong demand, especially higher inventories in China due to the coronavirus. Cash equivalents and short-term investments were $3.2 billion, which was $860 million lower, which is a huge amount lower. But that's pretty much, they say that share repurchase, dividends, and investments infrastructures were a huge reason for this. The net income that they provided that they got this quarter was not enough to do all the stuff that they did, so they had to dig in from their cash and cash equivalents. In theory, let's take a quick look. If $864 million was a decrease, this company can survive 4 more quarters with its cash to be able to still repurchase, have dividends, and continue strong investments. And this is assuming a very slow growth in the companies due to this coronavirus. I do think it's not going to last 4 quarters, but if it does, this company is going to be able to survive just fine. As we continue to look at the company's balance sheet right here, I have pulled up the balance sheet. Like I mentioned, cash and cash equivalents is down 23%. But if we take a look at the total current assets for this company, it's actually pretty similar. It did not grow. It's 0% growth, which means this company moved its current assets elsewhere. And the biggest thing we can see here is prepaid expenses and other current assets. So these are just some things that this company paid ahead of time we won't have to deal with it. So I think it's good that that's there, and that helped offset the huge decline in cash and cash equivalents. If we take a look at total assets grew about 14%, and that was about a $3.3 billion increase. But a huge portion of it, if you guys have been watching most of my videos, there's one thing that companies now need to report, and it's operating lease right of use assets. This is something that if we take a look, they did not have to report a year ago. So that alone was an extra about $3 billion increase, and that was a huge portion of this total asset increase. So this is where companies sometimes try to play games with you guys. They show, hey, we increased our total assets by 14%, but in reality, it's an asset that they already had, but they did not have to report. So it's pretty. I find it pretty. I mean, if you guys just take a look at the balance sheet, you'll be able to find that out. But it's just something to understand what's going on there. Next, let's take a look at this company's liabilities. The total current liabilities grew about 14%. Last year was 7.2 billion. This year's 8.2 billion. So about 1 billion increase. Again, just like that current asset that did not have to be reported about a year ago, there is similar things with the liability that did not have to be reported a year ago. So about that $1 billion, 400 million comes from current portions, comes from there. So they only grew about $600 million of liabilities. That's still a huge growth. It's close to 8% growth, but that came mainly from accrued liabilities. But still, total current liabilities, it did increase, but it wasn't a huge jump to really have me scared about anything. Next, let's take a look at long-term debt, which is pretty important. Long-term debt is pretty flat compared to the same time last year. So this company has not taken any new debt, or if it does, it's just a movement of timeline, which we'll probably see in the 10Q report when they post it sometime in a few weeks. Finally, the last thing we're going to talk about from what they presented before I give my evaluation of what I base this company, what I would pray for this company, is the coronavirus updates. So they do mention that China was hugely impacted in the third quarter. Revenues were down about 5% like we saw. But remember, they do mention that the first 2 months of the third quarter, so this ended February 29th. So they had all of December and all of January to do sales before China really shut down. And they say during those first 2 months of the third quarter, China's revenue grew strong double digits. But in the last month, it took a big hit. So we can see how impactful just 1 month of bad sales, even though they had 2 months of double-digit growth, 1 month of bad sales can really cripple a company's revenue. Right, 4% is not a big decrease, but knowing that the first 2 months were double-digit growth sales, and just 1 month was able to drop it down to low negative single digits. They did mention that currently about 80% of the stores are open back in China, and even a higher rate in the key cities, which I think is pretty good. It means that this thing goes, it leaves, and when it does, everything goes back to normal to some extent. They did mention here we're taking a look at their transcript from what they gave on the earnings, and they talk a lot here that they've learned a lot from the coronavirus in China, and they're using the same tactics that were used in China in the other countries. So they came up with some plan. In China. It seemed to work in China, so they're using that as a blueprint for the other countries, which I think is pretty smart. All right, there might be some tweaks that they have to do because just the way each country is handling it is going to be different. But it's just good to know that they have some form of blueprint, and they're telling us, hey, we have this already, so we're gonna try to fix it in the other countries. They do give some form of guidance for the next quarter, which I think is pretty good. Based on the latest trends in their business, they do believe that revenue in China will likely be flat compared to the same time last year. So we're gonna see in China we're gonna see a decrease in revenue compared to this year, to this quarter. And if this is happening in China now, it's only common sense to believe that they're also going to see a revenue decrease in the United States and in the Europe and Italy, Europe area. And it's good, and it's crazy. It's good to know that Europe makes up about 30% of the revenue, and the United States makes up about 40%. All right, so now we're going to take a look at Seeking Alpha one more time. I like to use their websites to also use the annual earnings per share estimates, and this helps me really value the company at future value. And I try to look at 2 years from now. So 2 years from now will actually be May of 2022, and this has been already revised. In the last 90 days, there has been 20 down revisions, and again, it has to do thanks to the coronavirus that there has been a decrease in everybody. About 20 analysts have come and revise their opinion on how the company is going to do. And I do trust these analysts. They have plenty of information to tell you. They give you good portions of how a company is going to do, plus or minus a few percentage. But what you do with that information is what determines how you value the company. For me, let's take a look at May 2021. This company is expected to make $2.96. All right, so for the next year, I want to do 2022. For 2022, let's say that at minimum, this company grows about 7%. So let's actually go with a little bit higher number. Let's just $3. We're going to times that by 1.07. So this company in 2022, I want to say would make somewhere around $3.21. And the reason I picked 7% is I was just looking at past revenue growth for this company. Last year was 7%. The year before that was 6%. The year before that was 6%. The year before that was 6%. So I felt 7% was a good value to do based on price on previous information. So based on previous information, 3.21. For me, I mean, this is a Nike. For me, it is a shoe company, but it's a brand. It is a strong brand. So I would give this about somewhere of a maybe 20 to 22 PE ratio that I would feel comfortable. Honestly, something below 20, I would actually feel pretty comfortable buying. So let's just see what a 20 PE ratio would give me for this company. That would give me a price range of 64.2. Again, this depends on every investor. For me, I don't see, there's plenty of growth in this, right? Nike is a brand, it's a strong brand, and we're seeing huge growth in every single department here. So actually, let me give this a little bit more, just because, right, we're seeing huge increase in other parts of the world, double-digit growth outside of the coronavirus. If that continues, we're also seeing this company to be able to buy back a nice amount of shares, and it has a decent amount of cash at hand. So let's go with that $3.21, and let's times it by the average 25 earnings per shares ratio, and that to me will still give me $80.25. $80.25 right now. This company is sitting at about $80 right now. So for me, it's not a company I would want to invest, and that's right. That's just because of my risk and reward to this company. Every investor has their own way of doing this, right? This company pays a dividend. This company does strong share buy repurchase. But for me, it's still an apparel company to me. So for me as an investor, I would not feel happy paying anything over a 25 for future PE ratio for sure. But just because I don't, it does not mean this is a bad investment. There could be someone that would sleep at night perfectly fine having a company like this, knowing that, hey, eventually it can go back to its prime at $100. But to me, I feel like there might be better investments elsewhere for me opposed to Nike. And that's all I'm saying. So I hope you guys enjoyed this episode. Right, we did see Nike strong dividends, strong revenue. We do know that Europe and United States make up 60% of total revenue, and these are countries that are being hit right now for Q4. But they do mention that, hey, after the thing passes, the revenue is gonna come back, and that's what we're all saying, right? So it is a great time to be buying companies. So I hope you guys enjoyed this episode. Don't forget to hit that subscribe button. Take care and have a good night.